This video was recorded as part of a seminar for CyberTrader Sydney. It discusses machine learning in conjunction with the technical analysis library TA-Lib. We discuss in this video how to download market data with Finance, produce candlesticks and make candlestick charts, use TA-Lib to produce technical indicators, and then use the TA-Lib functionality to combine it with machine learning to produce trading strategies. I really hope you enjoy this video and see you on the other side. Also, to download the notebook, please check out the link below.
TA-Lib for trading. Now, TA-Lib is basically a program or a tool of programs that give you a lot of tools for technical analysis. And as you probably know, technical analysis is an interesting part of quantitative trading. And, you know, some people really strongly believe in technical analysis. Others basically say, well, it's a bit more like reading tea leaves in a cup of tea. I'm somewhere in the middle, I suppose, but nevertheless, I use TA-Lib quite a lot because it does have some really interesting features, and some of these features we will explore today. And I hope there's something interesting for you as well. So as I said before, this notebook is designed to run in Google Collaboratory. So if you want to run it locally, you can basically just install the underlying programs and then just run it on your local computer. But if you want to run it as it is, you actually have to log into Google Collaboratory and make sure you run it there. And so to start with, in this notebook, I've just got a program that produces us candlesticks. Technical analysis works a lot with candlesticks. So sometimes if we have a candlestick graphing tool, it's nice to visualize specific things. So I've got this program here called Candlesticks. It's really straightforward. There's actually other programs that produce candlesticks as well. But I just wanted to keep to the most simple Python libraries that are out there. So I actually just wrote this little program here to make the candlesticks myself. Now, next, if we want to run TA-Lib, we have to download a few packages here. And the most important package, obviously, is TA-Lib itself. And what you can see here is basically the way to install TA-Lib on Google Collaboratory. So imagine Google Collaboratory is effectively like a server that you can use, like an external server. And so it's got quite a lot of Python stuff already installed on it, but some stuff it doesn't have installed. And what you can do in your Jupyter notebook is you can actually go and install other packages on that part of the server that you're using. Unfortunately, when you run this Colab program, you have to reinstall stuff again and again, so it's not persistent. But it actually doesn't take very long, so it just takes a few seconds. And so if you want to install TA-Lib, you have to effectively do what I've done here. It's like just Linux commands to install it. So, you know, for those of you who have still come in, we actually provide you with a link where you can download this notebook, or we send it to your email address. And so that link is in the chat box. If you want to, maybe Chan, you can send it again for those people who've just come in so they can see it. And, you know, you can actually just use this as it is and just download TA-Lib onto your Google Colab account. The next thing we want to also install is Finance. And Finance is a handy package because what it does is it takes the Yahoo Finance API and it then downloads the data from the Yahoo Finance API straight to your desktop. And that can be extremely valuable because there used to be times when we had Quantopian, and in Quantopian was a good environment to get a lot of market data. But unfortunately, that has gone away and we have to find workarounds. Yahoo Finance is really handy because it not only provides you with stock data, but also with a lot of other things, such as quite extensive options data. And if you want minute data, it provides them as well for 1 week looking backwards. So you get 1 week of historical 1 minute data, and otherwise you get basically open, high, low, close data all the way back to like pre-2000. For some companies, I found it goes back till 1963. So it's quite a lot of data there in Yahoo Finance. There is another package that we can install called MPL Finance. That's a plotting tool, which can be quite handy. It's basically Matplotlib Finance. MPL stands for Matplotlib. And it can also give us some interesting plotting. So that said, we can dive straight into the Python code. And if you're familiar with Python, we just have a few imports here. And those imports are basically just standard imports that you usually use. You know, we have pandas, NumPy. We've got yfinance, of course, we just imported, Matplotlib, and, you know, just some really basic things. And of course, not to forget, we also need to import TA-Lib. So the first thing we do is we download the data, and we can do this quite easily in yfinance. All you do is YF to download, then you put in the ticker that you want, you put in the period, so it tells you how long, how many days, for example, 50 days, and the interval. So that could be 1 hour, 1 minute, or 1 day, or 1 month, depending on what your needs are. But there's quite a lot more you can do with yfinance. And if you do $YF to .download, you can actually get a lot of information about this package as well. So that's a typical Jupyter Notebook thing. With the question mark, you can figure out what's in that package. Now, let's just get straight into building some indicators for technical analysis, because that's what we're really here for. And the simplest and most obvious indicator, obviously, that everyone that does any quantitative finance has been using is the simple or standard moving average. And the way we call this in TA-Lib is just simply with TA-Lib.SMA. SMA in capitals stands for simple moving average. And then what we do is, because we get the data as a data frame, so our market data come as a pandas data frame, we then go df data frame dot close. Close means the close price of in the data frame. So in the data frame, we obviously get the open, high, low, close values. So we do df dot close, and then here we put in the period of the look-back window in our simple moving average. Now, I don't want to go too much into the specifics of each indicator, because first of all, TA-Lib has well over 100 of those indicators. And secondly, you know, there is so many indicators, and in truth, there's quite a few indicators that I don't even know myself. I've never used them. And you know, it's really up to your specific needs, which indicators you want to do. But what I'm going to show you today is how to access those indicators and how to do this really efficiently and really well. So once we have downloaded the moving average, what we can do is we can actually plot this. So we can plot the data frame as a candlestick chart. And again, what's important here is, for a candlestick chart, we need the open, high, low, and close values. And for those of you who are not familiar with this, the red candles is where the close is below the open, and the green candles is where the opens are below the close. And then the wicks, they show us the high and low values of the candlesticks. And what we can do then is we can plot those candlesticks, and we can plot the 5-day moving average on top of it. And that's, you know, pretty straightforward. And, you know, some people, they basically, you know, build strategies where when they when a slow moving average crosses over a fast moving average, they enter a trade. And when it crosses back, they exit the trade. It's also called a moving average crossover strategy. And I sometimes call it the hello world of the quantitative trading strategies. It's probably one of the simplest quantitative trading strategies out there. And I often use it as a demonstration. Now, the next thing I want to show you, and this is really important to learn, because, you know, we have on one hand, we have TA-Lib, and the functions here are fairly straightforward to access. But what we also need to know is, how can we use TA-Lib to its maximum effectiveness? And so one of the things that we often use when we deal with market data is resampling. So when we, for example, have other market data, we can actually extract different information out of market data if we resample them. So let's just say we have minute data and we run a moving average over minute data, and then we resample it to daily data. We can actually get quite different information if we run an indicator over a different granularity of time. And so this is what I've done here. I've actually resampled the SPY close prices, the daily SPY close prices. So what we've basically done here is we resampled the 1 day data into 1 year data. So what I did here is I just took the SPY, the SPY, the S&P 500 ETF, and I downloaded the data from the beginning of when the data is available all the way to now. And then when you see here, this resampling function is actually fairly straightforward, and we can resample the close prices. And whenever we resample, we need to specify the way we resample it. So we could, for example, say, well, in each resampling period, say in the 1 year period, we just want the maximum price or the minimum price or the last price or the open price, so the first price. Or in this case, we want the open, high, low, and close values. So what Pandas allows us to do is we just say dot resample, and then we say dot OHLC, which means open, high, low, close. And we can actually get a resampling to new bar sizes, which is really, really quite good. And that gives us basically just the annual candlesticks. And that's what I've done here. I plotted the annual candlesticks. And what I've also interestingly plotted is a line of the close prices. And then you can see here how candlesticks work. So the close price for the red candles is always lower than the opening price, which is on top. So you can see that the close price here actually is at the bottom. And for the green candles, the close price is at the top. So you can see it's always top, 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 top. And then we get to a red candle, it's at the bottom. And again, all those things give us a good deal of information. And personally, I always say to people, you know, please plot things. Personally, I sometimes struggle just to look at a large amount of numbers. It's always really, really difficult when you just have a huge table also to make sense of it. You have to look for hours. And sometimes if you can turn things into a simple chart, it's just so much easier and so much more intuitive to see. And especially quant analysts are often a bit drawn to numbers, and they forget that sometimes it is really helpful to actually make a chart. Okay, so now in TA-Lib, there's different types of indicators that we have. Some of these indicators are basically just straightforward indicators, such as the moving average. There's also something called oscillators, and there's another thing called chart patterns. So I just quickly want to discuss the oscillators. And then once we have that, I show you some really, really cool stuff at chart patterns. Okay, so oscillators are quite well known in the technical analysis community. The one I plotted here is called the RSI, or also it's called the relative strength index. And what it does is it has values that oscillate between 0 and 100. And usually when it's at close to 100, it's said it is overbought. And usually then you expect the price to drop. And when it's close to 0, then it's oversold. And you would expect perhaps the price of the stock to increase at some point. Obviously, it's not that clear cut. But interestingly, I used some RSI variation recently on cryptos. And while I found that for equities, for stocks and futures, for example, the RSI doesn't really work that well. In fact, for some cryptos, it seems to be still quite good. So if anyone's interested in that RSI indicator, maybe you want to lay your hands on cryptos and you might find that it's quite interesting. Another one that is also used quite a lot is called the MACD, the moving average convergence divergence, I believe it's called. And so what's interesting here is, and the reason why I picked the MACD is because it has several outputs. So most of the indicators, such as the RSI, just has very simple output, just one. And it gives us a straightforward line that we can use maybe in our trading algorithms. Now the MACD is a little bit different. It's got three outputs. One is called the MACD, the other one is called the signal, and the third one is called the histogram. Now, if you want to know more about those, it's worth actually looking it up. Wikipedia is definitely your friend. There's heaps of videos on YouTube that explain MACD and so on. So you can find a lot of information on this indicator as well. And it basically uses several inputs as well. First of all, it uses the close prices. And in this case, we have the SPY close prices. And then it uses three different look-back windows. One is a fast look-back window, one is a slower look-back window, and one is basically a look-back. I forgot what the name of it is, but it brings those two look-backs together and it creates this histogram. And so we can run this, and then what I've done here is I effectively just have a few a little bit of plotting functionality just to make the plot a little bit more spicy. And what you can see here is basically all three of those outputs, the MACD, the signal, and the histogram, all in one plot. Now, again, all of this can be used for trading strategies. Today, we don't discuss or go not too deep into how you can make trading strategies with this, because we're more concerned with TA-Lib. So if we want to do this, let me know. Maybe we can talk about trading strategies based on these indicators another time, and then we can run another workshop on that. All right, so the final oscillator that I want to show you is called the ADX. It's also actually I'm not sure what ADX stands for at the moment. So if anyone can fill me in on that, I appreciate it. But the ADX is an indicator that's also used, and the reason why I picked that to show you how it works with TA-Lib is because it uses actually some candlestick as an input. So it uses the high, low, and close values as an input. And then you put in a singular look-back window. So remember, for the MACD, for example, we had three look-backs. For the ADX, we have only one look back, but we actually have three input values, the high, the low, and the close price. Now, what you can do is you can always use the question mark functionality to see what each indicator actually does and how to access them, and what the input values are. So if you want to use a specific indicator, just use the tools that are available to you in the Jupyter notebook, and you can actually access those indicators and what they mean and what they do. Okay, so So we talked about the oscillators, and the next thing I want to do is well, I just want to show you what's in TA-Lib. And so all we have to do in Python is just go dir, stands for directory, TA-Lib. So and when you actually look at this, you can so I just scroll through it. So it starts with some indicators here. There's actually not just indicators. This is like the arc cosine. Then there's, for example, this one is the Arun oscillator. ADX we already had. There's another Arun oscillator and another one. This is the arctan. It's another and arcsine. These are just trigonometric functions. You can get here, for example, Bollinger Bands, beta, and then CCI is another indicator, BOP, balance of power. So there's already a lot of indicators. And then under C, you see this whole slew of this thing here, CDL. And then it's got like really weird names like 3-star in South, or 3 white soldiers, or abandoned baby, or advanced block. Now, these are all candlestick patterns. And frankly, I have absolutely no idea what any of them are, but you can actually all look them up. Like if you look at either Wikipedia or Quantpedia, all these candlestick patterns are explained. I think the doji is quite a common one. There's also a hanging man and a hammer, and there's a lot. There's like over 30 of them. And yeah, as I said, I'm like, what do they actually do? And since I have really no idea, what I did is I really wanted to find out. So in the next bit, I actually built you a trading strategy that works with these indicators without me not even, or with these candlestick patterns, without me not even knowing what they mean. So actually, just to finish the directory, here we just up to C. So there's more indicators here. There's like, this one is really interesting. It's the Kaufman adaptive moving average. So you probably know that generally moving averages, you have to specify a lookback window. But with the adaptive moving average, you don't actually have to specify a lookback window. You have to specify something, but it really adapts to the volatility of your time series. So it's actually quite an interesting one to use, because it doesn't really change with the volatility of your prices, but it's adaptive. There's some indicators based on linear regression, our good old MACD. There's also log 10, so logarithms if you need them. There is quite a lot more. The relative strength index here, which is an interesting one. This is another one here, stochastic. You can take the standard, it's basically the rolling standard deviation. You can get that as well. And many, many more. The ultimate oscillator, Williams. So there's a lot of functions. There's also, if you look further, there's actually the same thing here called stream. So it's stream underscore something. And stream is good because if you run a live trading algorithm, the last thing you want is at every new time step, you don't want to recalculate all the moving averages, everything, like the whole data set again and again. And what stream does is you put in the data, but it just calculates your last value. So if you only need the last value, you don't really want to calculate the whole data set again and again. You actually just want to calculate the last value, and stream is really good for that. And I've actually got a little example here where I used non-streaming and streaming. So I just basically run this data set 100 times, and I run it with streaming and non-streaming. So I just calculate the simple moving average without stream and with stream. And you can see here that if I run it without stream the regular way, it takes 1.53 seconds per loop. If I run it with the streaming, it only takes 817 milliseconds. So about half the time. So just in this simple example, I could speed up my my algorithm by 50%. And that's significant, you know, it's the difference between maybe sometimes sitting there for 1 hour and waiting for the results, or 2 hours if you have a really, really big program. And that's definitely a really, really handy function. I only actually discovered that while I was making this talk, so I haven't actually used it before. Usually when I had to stream values, I build my own indicators, but this makes it much, much easier and better. All right, so now let's come to candlestick patterns. And this is where I dive a little bit deeper into the guts of TA-Lib to show you a few really interesting things. So as I said before, I don't really know what candlestick patterns they do, but what this does is when you apply this candlestick pattern to a time series, or to the open, high, low, close series, it basically gives you a 0 until it discovers that particular candlestick pattern in your chart. And when it discovers that candlestick pattern in your chart, it gives you a value of either -100 or +100 or something like this. So there's often 2 permutations of those candlesticks. They can be bullish or bearish. So you can have a bullish version of that pattern or a bearish version of that pattern. Usually if you have a bearish version, it gives you a -100. And if you have a bullish version, it gives you a +100. And quite often what people say, well, if I discover this pattern, then usually the price does something specific. So for example, in this case, I just picked a candlestick pattern is called 2 crows. So for example, if you see 2 crows as a pattern, you might say, well, if you see a bearish 2 crows pattern, you might actually, it might suggest that in the next period, your returns will go down. So this is not actually true. This is just, you know, how this candlestick pattern stuff works. And again, I'm not necessarily, or I have never been a big believer in stuff like that. But what I'm showing you next, it makes this quite interesting. So what I've done here is basically, first of all, I run a function here that runs through all the candlestick patterns and basically produces an output. So instead of just producing one output with one pattern, I produce this function here that gives me the result for each candlestick pattern that actually exists in TA-Lib. And so in order to do this, we need to be a little bit inventive in the way we use Python. So if you're new to programming, this might be a bit surprising to you. But what you can do is you can actually, you know, you can run through the directory of TA-Lib and you can get all the names of all the indicators, which is what I've done here. And then you can say, well, if in my attribute, or if in one of my names of these patterns is CDL, meaning like a candlestick pattern or chart pattern with candlesticks, I want to calculate the results for this applied to my SPY. So what I do is I basically use this function here, get attribute. So you can see here I use get attribute TA-Lib, comma attribute. And so the attribute is basically the name of the function that I want to use. So in this case, it's TA-Lib dot, for example, CDL 2 crows or whatever, or hanged man or abandoned baby, or whatever those names of those candlestick patterns are. And by using get attribute TA-Lib attribute, I can actually use this as a function by itself. So this is a different way of defining or running a function as the one that I had before. Before, you remember, I used TALib.SMA or TALib.RSI. Now I can use this, and I can actually sweep through all the functions that use the candlesticks. And of course, I have to then input open, high, low, close values for my SPY. And then I run this and I get a result. And then what I do is I collect all these results in this cols in this calls list for later use. And so what I then do is I take those results that I collected here and I put them all together in a pandas data frame. So basically now I have a data frame that gives me all the values for all the chart patterns at any given point in time for the SPY. Now what I've done next is I take all these chart patterns. So I say, oh, what can I do with these chart patterns? So I could say, well, one of the things I could do is I could just go and just sum them all up. I just basically say at the 26th of June 2020, what is the sum of all my chart patterns? So we might get some which are 100, some are minus 100, most of them will be 0. And so I sum them all up and I go, okay, what are the sums of these chart patterns on any given day? And this is what I've done here. You can see we've got them from about 1992 all the way till 2021. And you can see the maximum sum that we have at any given time is 900. So that means we get about 9 different chart patterns firing and on the bullish side. And the lowest we have is actually minus 700. So that's probably about 7 chart patterns firing on the bearish side at any given time. A lot of the time, there will probably be only like 1 or 2. And so you know, we can see what we do. So now, once we have produced all these chart patterns in a pandas data frame, the question is, can we actually use these chart patterns in their sum total to predict daily returns? And so the naive way to do this is basically simply say, okay, we take these chart patterns, we take the sum of all of them, and then we see, well, does the sum has any correlation with the return in the next period? And so that's what I've done here. I basically use the chart pattern and I run a correlation, and you can see here that I produce the returns of the SPY. So we get spy.close.percentage change. So what we want is the percentage change of this SPY, not the actual prices, because as you probably know, we shouldn't predict prices, we should predict returns. That's what we're really here to do. And so I take the returns, and then what I need to do is, this is really important, I need to shift the returns. And so there's various ways to shift the returns. And so in order to get the previous date, I actually, or the date of the next day, I actually need to shift my returns to the left. So then my current indicator value is aligned with the future return. Okay, so you can see here I have SFT, which is my shift value, is -1. So what I do is I shift them 1 day to the left. Okay, and then that means that I can correlate the current value of my indicator with the future return. Okay, and so that's what I've done. And what I've also done is I then used those values and I did a linear fit of them. So I basically correlated all the returns with my indicator values. So we're really we're really seeing well, if those indicator values actually had any predictiveness, right, and you would see a big spike positive, you would actually then also see a positive, or you would have a correlation to positive returns. And if you see a spike to the negative, we would have a correlation to negative returns. But what you can see here is obviously pretty much a straight line. So it's just a blob. So what we can see here, obviously, that's not predictive, right? So the naive way of doing it is just simply not predictive, and we can totally discard this. So we can say, well, if we are just like really, like I would say, a little bit dumb and basic, and we just add them all up, that doesn't really help us very much. And so what I've done is also I built a really, really brief backtest where I basically said, okay, if you have a positive signal, go long. If you have a negative signal, go short. And you can see the strategy really doesn't perform very well. It just really loses money. And so, we're no good. If you want to know how to, so basically that's like probably as short a backtest as you can possibly write. If you're interested in how to do this, I don't really want to discuss this too much today, but if you're interested, let me know. What I could do is I could actually run a whole a workshop once on how to write backtests and how to write simple backtests and more complicated ones. I've done this for like well over a decade. And actually, I don't ever use platforms to run backtests. I always build my backtests myself because I have full control over what I'm doing. And I would highly encourage you to do the same thing. I must say that I never trust any backtests from any platform. I've seen so many erroneous results with them, and I would be and I'm quite reluctant these days to run backtests on any platforms. There's just too many hidden inconsistencies. So if you really into this, I would really highly recommend write your own backtests. It's hugely beneficial, especially if you get a good routine in writing them. All right, now after we've done it the naive way, what I want to show you then is, let's just use really simple machine learning. And what we're using here is a multivariate linear regression. And so this is probably as simple as it gets in terms of machine learning, but we could effectively exchange that linear regression with any other machine learning package that scikit-learn offers. So if you're not familiar with machine learning, there's a package in Python called scikit-learn, and it offers a huge amount of different machine learning packages. And so you can get from really simple stuff like linear regression to support vector machines, to clustering stuff like k-means or k-nearest neighbors, decision trees, random forests, all sorts of really weird and wonderful machine learning algorithms. And any of them can really be plugged into what I'm showing you here. This is the beauty of sklearn. Now, obviously, I don't have time today to talk about all of them. So I just chose linear regression because it's something most people understand. So multivariate linear regression, for those of you who are not sure, is basically, instead of just having an XY axis, you have x1, x2, x3, and then just one Y axis. So you have multiple inputs and just one output. And so what I've done then is I basically, instead of adding up all the candlesticks, I actually put them in as values, and each candlestick value is on a different axis. So I have about 32 different axes. So I have x0 to x, let's say 31 or 32 or whatever the number is. And then I have my y-axis, which is the return. And then what I do is I take this model and I fit it. So I fit my candlestick patterns to the shifted returns of my output. And then I get effectively a specific, I get a value that I train it on. And then you can see here, I defined a period with OOS, which is my out of sample period. So I've trained the values on a specific period. And then I take another period, which is my out of sample period, where I test whether my thesis or my assumption that this is predictive actually shows whether it's true or not. So here I can do this. I can say model.fit, so that fits my model to the data that I have available. And then here I can go, okay, model.predict. So with the predict step, I'm actually applying my model to the data that is yet unknown, that we don't know yet what the model will do. And so I can do this, and then I can actually compare this then with the real values. So I can predict this, and then I can compare it with what's actually happening. And what you can see here is, again, I plotted the predicted versus the actual results, and so it's quite a big blob, and it doesn't really look like there is much there. So it looks like, again, we tried another backtest. We've had already one backtest. Now we try another thesis, and there's obviously little slope, but it's not that impressive. And the slope has is 0.01. It's not very much. If it was 100% predictive, the slope would be 1.0. Obviously, that's never going to happen, but that's when you see it's like a super predictive thing. And so what we can do is, nevertheless, we can take our strategy, which doesn't necessarily look particularly good, and apply it to the trade, or we write a backtest of it. And so this is what happened here. So when we see here, the blue line is our benchmark, that's our SPY, and the red line is our trading strategy. Now what we can see is, hey, it's not doing great, but it's actually not too bad. So we built a strategy. It's like a long short strategy. It goes long sometimes, it goes short. But what it does is it's not performing fantastically, but at least it's actually not too bad. It's tracking the S&P 500 pretty well.
Well, we have seen that when we use linear regression, the results are okay, but they don't really improve on the benchmark returns very much. So we wouldn't want to trade this strategy because it's not that fantastic. Now the question is, just with this random strategy that we made up from chart patterns, is there any way we can actually build something that is slightly improved to the benchmark? And we don't want to go too far down that rabbit hole, because, as you know, as soon as we start trying many different strategies, it's very, very easy to overfit strategies, and we don't want to go there. Now, one thing that we could definitely do is, instead of using linear regression, we could use logistic regression. Obviously, this sometimes works better, specifically if we have outputs that are categorical. In our case, we turn our linear output into a categorical output anyway, because in this case here, you can see we already say, well, we're using the positive or negative return directions anyway, and we don't really care about the size of our predictive values, just the sign of our predictive values. So what I've done here is, instead of using linear regression, I used logistic regression. Then you can see that for the classifier, we use the sign of this straight away. So we put this into our machine learning algorithm rather than using the sign as an afterthought in the backtest. Okay, and so as I'm running this, you can see here it works very much the same way as for the linear regression. We do our fit step, then we do our predict step, and then I leave all the rest as before when we use the linear regression. And you can see we get some results as well. They look a little bit different than they did for the linear regression. Now the next bit is quite interesting. So you can see here, sometimes it's really quite similar to the underlying benchmark. Sometimes it performs a little bit better. But overall, it doesn't look particularly great. However, what we can also see here is that the returns of those two time series, they're not always overly correlated. So of course there are areas where there is a strong correlation, for example here, and you can see in this area there's quite a bit of correlation, and also here. But then there's quite a few areas where actually our results go the other way. So we assume that the correlation isn't that amazing between the returns of the benchmark and our strategy. And what this means is we can look at those two strategies as two different strategies. And often perhaps you know that if we combine two strategies that have a similar performance but are not very correlated, we're not necessarily improving the performance overall, but we can definitely mitigate a lot of the risk of either of the individual strategies. And so let's have a look how this looks. So what I have done here is I just came and I added the two strategies. So you can see this here are combined. So we have the strategy, then we have the combined strategy. I just added them up and divided them by 2. I just took the average of the two different returns, which is basically equivalent of putting half of the money in one strategy and half of the money in the other strategy. Now don't forget, one of the strategies is long short. So what this really means is that if both our strategies are long at the same time, then we have, let's just say for the sake of the argument, 2 long, or we go long the SPY. But if we have one long, one short, we're actually ending up being net zero. So we definitely still have a long bias in our strategy, but we could go either really long, we could go a little bit long, or we could go long and short. And so this is what's happening here. And then as we combine the two strategies and we run it, we can then go and plot the Sharpe ratios of the two strategies. And this is where it gets really interesting, because you can see here that the Sharpe ratio of the underlying is actually 2.23, whereas the Sharpe ratio of our combined strategy is 3.23, which is significantly higher. And don't forget, we are doing this out of samples, so we have trained our system on a different data set than we use for this. Now, an increase of 1 whole point in the Sharpe ratio is definitely a big deal, and it means that we can definitely improve what we're doing risk-wise quite a bit. So before you go, please don't forget to subscribe and smash the like button so we can get a bit more traction on YouTube. And also don't forget to check out our other YouTube videos, some of which are really quite interesting. We also have 2 courses in Udemy. One is a basic Python for traders and investors course, where you learn a lot of quantitative techniques combined with learning the right programming skills in Python that help you to get quantitative trading right. And the second course is on futures trading, and it's a very deep dive into the ins and outs of futures trading, including quantitative trading and some interesting strategies that you can use in the markets. I hope you enjoyed this video, and we will see you in the next video next time. Bye bye.